The S&P 500 just hit an all-time record on the same day the U.S. published the hottest wholesale inflation print since 2022. That contradiction is not an anomaly. It is the market's central bet, and understanding whether it holds requires tracing exactly where this inflation is coming from and where it is going next. The Producer Price Index surged 1.4% in April alone, 6% year-over-year, the largest annual jump since 2022. The surface read is straightforward. The Iran war shut down the Strait of Hormuz, oil prices climbed nearly 50% since late February, and fuel costs are bleeding into every supply chain. Transportation and warehousing prices alone jumped 5%, which means the energy shock is no longer confined to the gas pump. It is moving into groceries, airfare, and electricity bills, the costs that shape how ordinary households experience the economy, regardless of what an equity index reads. What that sequence makes harder to argue is that this is a one-time supply shock that will self-correct. The IEA's May report found that global oil supply dropped another 1.8 million barrels per day in April. Commercial crude inventories in the U.S. have now fallen for 7 consecutive weeks. The world has lost an estimated 1 billion barrels of supply over 75 days, a number that, as one analysis put it, has no precedent in peacetime. OPEC has acknowledged that the Hormuz closure has cut its members' output by roughly 30%. Iran, for its part, is now treating tanker passage through the strait as a case-by-case negotiation rather than a right, which means the supply disruption is not a temporary blockage but a structural shift in how the world's most critical oil choke point operates. That structural shift is what the equity market's record close does not yet price. Stocks rallied Wednesday because AI earnings momentum was strong enough to absorb the inflation data. Nvidia's positioning on Trump's China delegation reinforced that read. But the inflation mechanism that oil has set in motion does not need a further price spike to keep running. The second-order effects, higher freight, higher input costs, tighter household budgets, are already printing in the data, and they will continue to print even if crude stabilizes here. The question the record close leaves open is not whether the Iran war will end, but whether the damage it has already done to the price level is reversible on any timeline that matters for monetary policy.
That question landed directly on Kevin Warsh's desk the morning after his Senate confirmation, the narrowest in Fed history, 54-45, because the economic environment he inherits makes the answer politically impossible to avoid. Warsh was confirmed on the same day the PPI print dropped. He inherits an institution where several colleagues have already signaled that the next policy move could be a rate increase. Boston Fed President Susan Collins said Wednesday that more than 5 years of above-target inflation had reduced her patience for looking through supply shocks, and that she could envision a scenario requiring policy tightening. The CME FedWatch tool now prices 34% odds that the Fed's target rate ends 2026 higher than it is now, double the 16% reading from 1 week ago. Bond markets have already moved. Treasury yields hit their highest level in nearly a year as investors fled government debt after back-to-back inflation reports. The tension at the center of Warsh's opening position is that he was appointed by a president who has publicly and repeatedly demanded rate cuts, and he now faces data that makes cuts economically indefensible in the near term. Trump said explicitly before boarding Air Force One for Beijing that Americans' financial struggles were not motivating his Iran negotiations, that the only thing that mattered was denying Iran a nuclear weapon. That framing gives Warsh no political cover to wait for energy prices to normalize before acting. The war's end is not tied to domestic economic pain, so the Fed cannot credibly model a supply shock reversal on any given timeline. Wages are now losing to prices for the first time in 3 years. The personal savings rate has fallen to 3.6%. Consumer sentiment is at record lows. These are not leading indicators of a slowdown that will reduce inflation pressure. They are lagging indicators of purchasing power already eroded. The equity market's record close reflects AI-driven earnings momentum that exists in a different part of the economy than the households absorbing $4.50 gasoline. What Warsh must decide is whether those two economies can continue to diverge, and for how long the bond market will allow them to.
The divergence between the AI-driven equity rally and the energy-driven inflation spiral converges in Beijing, because the Trump-Xi summit is the only near-term event that could alter the supply trajectory and the Fed's calculus simultaneously. Trump arrived in China with the Iran war unresolved and rare earth export controls from Beijing still pending. The bombing of Iran that launched the conflict has left the U.S. military depleted of weapon stockpiles that require rare earth minerals China dominates.
A temporary extension of Beijing's rare earth export postponement is now the most consequential near-term supply chain variable for U.S. defense and technology sectors, which is why Nvidia's Jensen Huang and Boeing CEO joined the delegation. Boeing is positioned to sell jets. Nvidia needs chip-related materials. Both need Beijing to keep the rare earth channel open. Traders entering the summit were pricing a tariff truce extension and a Boeing aircraft purchase as the base case, but neither of those transactions touches the inflation mechanism the oil shock has already set in motion. The exception would be a credible Iran peace framework emerging from the Beijing talks. Trump has previously indicated China could help intermediate. If a Hormuz reopening timeline became visible from those discussions, oil futures would reprice, the second-order inflation effects would lose their forward momentum, and Warsh would gain the political and analytical room to hold rates rather than hike. That is the recovery scenario. The countersignal is Iran's own posture. Tehran is now managing Hormuz passage case by case, which suggests it retains operational leverage over the choke point, regardless of any diplomatic framework that does not include direct Iranian concession. The verification benchmark to watch is the CME rate hike probability. It stands at 34% today. If Beijing produces a concrete Iran framework, that number should fall toward 20% within 48 hours as energy futures reprice. If it stays above 30% after the summit concludes, the market is telling you that the inflation mechanism is now running independently of the geopolitical trigger, and Warsh's first rate decision will not be a hold. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.